If you depend on your savings maintaining purchasing power, if your retirement plan assumes bonds and stocks will preserve wealth across decades, if you believe the system that has functioned your entire adult life will continue functioning, the assumptions underlying all of these beliefs have been fundamentally challenged by data released in the past 90 days. Ray Dalio has warned for over a decade that when government debt reaches levels where interest expense consumes revenue faster than growth can offset it, when monetary and fiscal policy become indistinguishable, and when internal political conflict prevents necessary adjustments, the system enters what he calls the end of the long-term debt cycle. This is not theory. This is pattern recognition from studying the decline of reserve currencies across 5 centuries. In November 2025, U.S. federal interest expense reached $1.2 trillion annually, 21% of total federal revenue, and exceeding defense spending for the first time in peacetime. The debt-to-GDP ratio stands at 123%, with structural deficits exceeding $2 trillion annually, despite 3.9% unemployment and 2.4% GDP growth. This configuration has appeared only 3 times in the past century: Weimar Germany, 1921, 1923, Japan, 1989 present, and the United States, 1944, 1946. I'm John A.G., and this is the Collapse Files. When interest expense permanently exceeds the capacity to service it through growth, and when the only solutions require either inflating away the debt or defaulting outright, what does 5 centuries of reserve currency transitions tell us happens next? The Congressional Budget Office released updated fiscal projections in November 2025, showing federal interest expense reaching $204 trillion for fiscal year 2025, representing 20.8% of total federal revenue of $579 trillion. This marks the first time since World War II that interest expense exceeded 20% of revenue, and the first time in U.S. peacetime history that interest expense exceeded defense spending, which totaled $874 billion. The acceleration is recent and structural. In fiscal 2020, interest expense was $523 billion, 9.1% of revenue. By fiscal 2022, it reached $718 billion, 12.4% of revenue. Fiscal 2024 saw it surge to $1,049 trillion, 18.1%. The increase from $523 billion to $1,204 trillion represents a 130% increase in 5 years, while revenue increased only 32%, from $4.05 trillion to $5.79 trillion. The driver is the interaction between accumulated debt and normalized interest rates. Federal debt held by the public reached $28.3 trillion by November 2025, up from $21.0 trillion in 2020. The weighted average interest rate on this debt has risen from 1.9% in 2020 to 3.8% in 2025, as low-rate pandemic-era bonds mature and refinance at current market rates of 4.5 to 5.0%. The CBO projects that if current laws remain unchanged, interest expense will reach $1.7 trillion by 2030, representing 24% of projected revenue, and $2.4 trillion by 2035, consuming 29% of revenue. These projections assume average interest rates of 4.2% by 2030. If rates remain at current 4.7% or rise further, the projections worsen materially. This trajectory matches precisely the pattern Ray Dalio outlined in his 2020 paper, The Changing World Order, and expanded in subsequent analyses. Dalio identified that reserve currency empires enter terminal decline when 3 conditions converge: debt levels exceed 100% of GDP with rising trajectory, interest expense exceeds 15% of revenue and rising, and internal political polarization prevents fiscal adjustment. The United States now meets all 3 conditions simultaneously. Dalio's framework draws from studying the Dutch guilder's decline as reserve currency in the 1700s, the British pound's decline from 1914-1945, and earlier transitions, including the Spanish real and Portuguese escudo. Each transition followed similar patterns: initial debt accumulation, financing military dominance and global trade, followed by debt service consuming increasing revenue shares, culminating in either explicit default, currency debasement through inflation, or gradual loss of reserve status as creditors diversify holdings. The November 2025 data confirms the United States has entered the phase where debt service is consuming revenue at rates that cannot be sustained without either dramatic fiscal consolidation, requiring $2 trillion in annual deficit reduction through spending cuts or tax increases, or monetary intervention suppressing interest costs through Federal Reserve purchases, accepting resultant inflation. The fiscal consolidation path appears politically impossible. Reducing the deficit from current $2.1 trillion to zero would require either cutting all discretionary spending, including defense, by 100%, or raising all federal taxes by 36%, or eliminating all transfer payments to individuals, including Social Security and Medicare. No political coalition supports any of these paths. Partial adjustments, reducing deficits by $500 billion through modest spending cuts and tax increases, are being discussed, but would still leave deficits at $1.6 trillion, allowing debt to continue growing faster than GDP. The monetary intervention path risks repeating mistakes that created current inflation. The Federal Reserve implemented $5 trillion in quantitative easing from 2020 to 2022, suppressing Treasury yields and financing deficit spending. This contributed to inflation reaching 9.1% in 2022, forcing the Fed to raise rates from 0 to 5.225%, the fastest tightening in 40 years. Returning to QE to suppress interest costs would risk re-accelerating inflation, potentially worse than before, given that inflation expectations are no longer anchored at 2%, as they were pre-2021. The data released in November 2025 moves Dalio's warnings from theoretical framework to empirical confirmation. The patterns he identified from historical reserve currency transitions are now observable in current U.S. fiscal data. Interest expense at 21% of revenue with structural deficits at $2 trillion annually. Despite strong employment and moderate growth, indicates the system has reached configuration where debt service consumes resources at rates incompatible with maintaining both currency stability and fiscal solvency simultaneously. Sovereign debt systems function sustainably when debt service, the interest payments on accumulated borrowing, consumes a modest share of government revenue, allowing ample resources for defense, infrastructure, transfer payments, and public services, while maintaining capacity to service debt even during recessions when revenue falls and deficits widen temporarily. The United States operated within these parameters for most of its history. From 1950 through 2000, federal interest expense averaged 8.5% of revenue despite wide variation in debt levels. Even when debt reached 48% of GDP in the early 1990s, interest expense peaked at 15.4% of revenue in 1991 before declining as economic growth and fiscal discipline reduced debt ratios through the late 1990s. The system depends on growth rates exceeding interest rates on average. If nominal GDP grows at 5% annually, 3% real growth, plus 2% inflation, and the government borrows at 4% average interest, debt is sustainable indefinitely as long as primary deficits. The deficit excluding interest expense remain modest. Tax revenue grows with GDP at 5%, while interest grows with debt stock at 4%, allowing the debt-to-GDP ratio to stabilize or decline over time, even with small primary deficits. The mechanism breaks when interest rates persistently exceed growth rates. Current nominal GDP growth is approximately 4.9%, 2.4% real plus 2.5% inflation. Average interest cost on federal debt is 3.8% currently, but rising toward 4.5% as low-rate debt matures. If interest costs reach 4.5%, while growth remains at 4.9%, the differential is only 0.4 percentage points. This provides minimal buffer. Any recession reducing growth to 1 to 2%, while interest costs remain elevated, creates a configuration where debt grows faster than GDP indefinitely. Additionally, the United States runs substantial primary deficits, the budget deficit excluding interest expense. In fiscal 2025, total deficit was $2.1 trillion with interest expense of $1.2 trillion, implying primary deficit of $900 billion. This means, even if interest expense were zero, the government would still borrow $900 billion to fund operations. Combining $900 billion primary deficit with $1.2 trillion interest expense creates total deficit of $2.1 trillion that must be financed through new borrowing. The debt spiral dynamic emerges when interest costs exceed primary surplus capacity. If interest expense is $1.2 trillion and the government cannot achieve primary surplus through spending cuts or tax increases, then a portion of new borrowing goes to pay interest on old borrowing, the classic debt spiral. Currently, approximately 57% of new annual borrowing, $1.2 trillion of $2.1 trillion, is to pay interest. This ratio will worsen as interest costs rise. The system is failing at the adjustment mechanism level. Historically, when debt service approached unsustainable levels, either markets forced adjustment by demanding higher yields that made borrowing prohibitively expensive, or politicians implemented austerity, recognizing that continuation would lead to crisis. Neither mechanism is functioning currently. Markets are not forcing adjustment because the Federal Reserve and foreign central banks absorb substantial treasury issuance, providing artificial demand that keeps yields below where private markets alone would clear. In 2023-2024, the Fed held $5.0 trillion in treasuries despite implementing quantitative tightening without the Fed's holdings. Private markets would need to absorb that supply, requiring higher yields. Foreign official holders own $7.3 trillion in treasuries, though this has declined from $7.7 trillion in 2021, indicating reduced foreign willingness to accumulate additional U.S. debt. Politicians are not implementing austerity because the political system has become polarized to the point where compromise on fiscal matters is nearly impossible. Proposals to reduce spending on entitlements like Social Security and Medicare face opposition from constituencies dependent on those programs. Proposals to raise taxes face opposition from those who would pay higher taxes. Proposals to reduce defense spending face opposition from defense hawks, citing threats from China and Russia. The result is gridlock where deficits persist, despite widespread acknowledgement they are unsustainable. Citizens and investors are trapped in a system where they depend on currency stability and government solvency, but have limited ability to influence outcomes. Individuals holding treasury bonds as retirement savings depend on those bonds maintaining value. But if the government inflates to service debt, bondholders lose purchasing power. Savers holding cash depend on currency stability, but if the government debases the currency through monetary expansion, cash loses value. The only alternatives, holding gold, foreign currencies, real assets, require active management and carry their own risks. The Federal Reserve is trapped between mandates. It is supposed to maintain price stability, keeping inflation near 2%, and support full employment. But it also has an unstated mandate to facilitate government borrowing. If the Fed raises rates to control inflation, it increases federal interest expense, worsening deficits, and potentially triggering fiscal crisis. If the Fed keeps rates low or implements QE to suppress borrowing costs, it risks inflation. The Fed has no policy setting that simultaneously achieves price stability, full employment, and fiscal sustainability. The system mechanics reveal a configuration where the traditional constraints on excessive debt accumulation, market discipline through higher yields, and political discipline through austerity have been suspended through monetary intervention and political dysfunction, allowing debt and interest expense to reach levels that cannot be sustained through conventional adjustment mechanisms. The quantitative evidence shows not just elevated debt and interest, but acceleration toward unsustainable thresholds across multiple metrics simultaneously. Federal debt held by the public reached $28.3 trillion in November 2025, representing 123% of GDP. This represents the highest peacetime debt ratio in U.S. history, exceeding the 119% reached in 1946 following World War II. But the 1946 ratio declined rapidly to 92% by 1950 and 55% by 1955, through economic growth averaging 4.5% annually and inflation averaging 5.7% that eroded real debt value while nominal GDP surged. Current conditions offer no comparable growth or inflation tailwind. Real GDP growth has averaged 2.2% over the past decade and is projected to average 1.8% over the next decade as demographics worsen. And productivity growth remains modest. This means debt-to-GDP ratios will not decline through growth as they did post-WFP, without inflation rising materially above current 2.5%. Interest expense trajectory shows explosive growth ahead. The $1,204 trillion in fiscal 2025 compares to CBO projections of $1.7 trillion by 2030 and $2.4 trillion by 2035. These projections assume average interest rates of 4.2% through 2030. But the current weighted average rate is already 3.8% and rising toward 4.5 to 4.7% as low-rate debt matures. If average rates reach 4.7% by 2030 instead of the CBO's 4.2% assumption, interest expense would be $1.95 trillion instead of $1.7 trillion, $250 billion higher due to 50 basis points of higher rates. The sensitivity of interest expense to rate changes is severe given the debt stock. Each 100 basis point increase in average interest cost adds approximately $283 billion to annual interest expense on $28.3 trillion of debt. With $9 trillion of debt maturing over the next 3 years, requiring refinancing at current market rates of 4.5 to 5.0%, the weighted average cost will continue rising by approximately 15 basis points quarterly, adding $42 billion to annual interest expense every 3 months. Primary deficit trends show no improvement despite strong economic conditions. The primary deficit, total deficit minus interest expense, was $900 billion in fiscal 2025. This occurs during a period when unemployment is 3.9%, GDP is growing 2.4%, and no recession is occurring. Historical analysis shows primary deficits during economic expansions averaged $200 billion from 1950 to 2020. Current $900 billion primary deficit is 4.5 times the historical expansion average, indicating structural spending exceeds revenue by amounts unrelated to economic weakness. Revenue as share of GDP shows limited capacity for increase. Federal revenue totaled $5.79 trillion in fiscal 2025, representing 19.8% of GDP. The historical average from 1950-2020 was 17.4%. Current revenue at 19.8% is already 240 basis points above historical average, indicating the economy is being taxed at above average rates. Raising revenue materially higher, say to 22% of GDP to match some European nations, would require tax increases on middle-income households, given that high earners already face marginal rates approaching 50% federal plus state. Political feasibility of such increases is questionable. Spending as share of GDP shows unsustainable trajectory. Federal spending totaled $7.9 trillion in fiscal 2025, representing 27.1% of GDP. The historical average from 1950-2020 was 20.3%. Current spending is 680 basis points above historical average. The excess spending is concentrated in three areas: Social Security and Medicare, growing with demographics, defense elevated due to geopolitical tensions, and interest rising mechanically with debt stock and rates. Entitlement spending growth is demographically locked. Social Security spending is $1.35 trillion in 2025 and projected to reach $2.3 trillion by 2035 as baby boomers age and beneficiary counts increase from 70 million to 85 million. Medicare spending is $848 billion in 2025 and projected to reach $1.6 trillion by 2035. Combined entitlement growth of $1.12 trillion over 10 years is baked into demographics and cannot be prevented without legislating benefit cuts or eligibility, age increases that no political coalition supports. The debt service coverage ratio, the number of times revenue covers interest expense, has deteriorated severely. In 2000, revenue of $2.03 trillion covered interest of $223 billion 9.1 times. In 2020, revenue of $3.42 trillion covered interest of $523 billion 6.5 times. In 2025, revenue of $5.79 trillion covers interest of $1,204 trillion 4.8 times. The coverage has declined by 47% from 2000 to 2025, indicating interest is consuming revenue at accelerating rates. Foreign holdings of U.S. Treasuries showed declining demand. Foreign official and private holders owned $7.74 trillion in treasuries at the April 2021 peak. Current holdings total $7.28 trillion, a decline of $460 billion or 6%. During the same period, total treasury debt grew from $28.2 trillion to $35.8 trillion, a 27% increase. Foreign holders absorbed none of the $7.6 trillion in new issuance and reduced absolute holdings. Their share of total debt fell from 27.4% to 20.3%. This requires domestic buyers, primarily the Fed, banks, pension funds, and households, to absorb 100% of new issuance plus the amounts foreign holders are selling. Domestic absorption at this scale requires yields high enough to attract demand, explaining why the 10-year Treasury yield has remained elevated near 4.5% despite the Fed cutting short-term rates. The convergence of these metrics, debt at 123% of GDP rising, interest at 21% of revenue rising toward 29%, primary deficits at $900 billion with no political path to reduction, foreign demand declining requiring domestic absorption of massive issuance, creates a configuration that Ray Dalio's framework identifies as unsustainable without either crisis-forcing adjustment or intentional policy shift toward inflating away the debt. Dalio's analysis draws heavily from the British pound's transition from reserve currency status between 1914 and 1945, providing the most detailed comparable precedent for a gradual rather than catastrophic loss of reserve dominance. In 1914, the British pound was the undisputed global reserve currency used in approximately 60% of international trade settlements and held as 65% of global central bank reserves. British government debt was approximately 28% of GDP, manageable and sustainable. The empire controlled 25% of global GDP and 25% of global population, providing taxable capacity supporting the currency. World War I required massive deficit spending. British government debt rose from 28% of GDP in 1914 to 180% by 1919, as the government borrowed extensively to finance military operations. Interest expense surged from 8% of government revenue in 1914 to 23% by 1920. This crossing of the 20% threshold, where interest exceeded 1/5 of revenue, marked the beginning of fiscal stress. Britain attempted to return to gold standard in 1925 at pre-war parity, requiring deflation to restore currency value. This created economic depression, unemployment reaching 11% by 1921, and political instability. The attempt to maintain currency credibility through austerity and deflation while servicing 180% debt to GDP proved impossible. Britain abandoned the gold standard in 1931, allowing currency devaluation. World War II worsened the dynamic. Debt reached 238% of GDP by 1947. Interest expense exceeded 35% of government revenue. Britain was forced to accept American loans, with conditions including dismantling trade preferences that had supported the pound's international role. The 1945 Anglo-American Loan Agreement required Britain to make the pound convertible, exposing it to market forces that revealed its weakness. The pound's share of global reserves declined from 65% in 1914 to 55% in 1930, to 45% in 1950, to 20% in 1970, finally settling near 5% by 1990. The transition took 76 years from initiation to completion, but the crucial phase, when reserve status became untenable, occurred in the 1940s, when debt exceeded 230% of GDP and interest consumed over 35% of revenue. The parallel to current U.S. conditions is the pattern, not the timeline. Britain, at 238% debt with 35% of revenue to interest, faced physical destruction from war and loss of empire. The U.S., at 123% debt with 21% of revenue to interest, faces no comparable physical destruction, suggesting the timeline could extend longer. But the directional pattern, rising debt, rising interest share, declining foreign willingness to hold the currency, eventual forced adjustment, matches. Weimar Germany, 1921 to 1923, provides the catastrophic rapid adjustment precedent. German government debt reached approximately 130% of GDP by 1921, following World War I reparations and war debts. Interest expense consumed over 25% of revenue. The government faced impossible choices: raise taxes on an already devastated economy, cut spending including to war veterans, creating political backlash, or monetize the debt through Reichsbank money printing. Germany chose monetization. The Reichsbank purchased government bonds, creating money to finance deficits. This worked briefly, from 1921 to mid-1922. Inflation remained moderate at 40-50% annually, painful but manageable. But the process was reflexive. Money printing caused inflation reduced real tax revenue shortfalls required more money printing, accelerating inflation. By late 1922, monthly inflation exceeded 100%. By mid-1923, it reached thousands of percent monthly. The currency collapsed entirely. The exchange rate went from 4.2 marks per dollar in 1914 to 4.2 trillion marks per dollar by November 1923. The episode ended only through complete currency replacement, introduction of the Rentenmark backed by industrial assets and land rather than government debt. The Weimar precedent shows that attempting to monetize debt to GDP ratios above 100%, with interest consuming over 25% of revenue, risks hyperinflation if the process becomes reflexive. The U.S. is not Weimar. It has far stronger institutions, deeper capital markets, and the dollar benefits from network effects as reserve currency. But the pattern, monetization to avoid default or austerity leading to inflation potentially becoming uncontrollable, is the risk Dalio identifies in his framework when debt and interest metrics cross critical thresholds without political capacity for fiscal adjustment. Both precedents, British gradual decline and Weimar catastrophic collapse, occurred when government debt exceeded 100% of GDP and interest consumed over 20% of revenue. The U.S. has now reached both thresholds simultaneously. The mainstream financial narrative frames current debt and deficit levels as concerning but manageable, emphasizing that U.S. enjoys reserve currency status, allowing borrowing in its own currency, that markets continue clearing treasury auctions at reasonable yields, and that historical examples like Japan show that high debt-to-GDP ratios can persist for decades without crisis. This framing misses the critical dynamic Dalio emphasizes. Reserve currency status is not permanent. It is conditional on maintaining creditor confidence that the currency will preserve purchasing power. Once that confidence erodes, visible through foreign reserve diversification, rising term premiums on long-dated bonds, or currency weakness, the process becomes reflexive and potentially irreversible without dramatic policy shifts. The Japan comparison is misleading in crucial ways. Japan's government debt exceeds 260% of GDP with interest expense at approximately 8% of revenue, despite debt levels double the U.S. ratio. This appears to prove that high debt is sustainable, but Japan's debt is 90% domestically held by Japanese banks, pension funds, and households with cultural propensity to hold government bonds regardless of yield. Additionally, the Bank of Japan implements yield curve control, capping 10-year yields at 1.5% through unlimited bond purchases, preventing market-based price discovery. The U.S. cannot replicate this model. Foreign holders own 20% of U.S. treasuries and are reducing exposure, not increasing. Domestic households hold only 12% of treasuries, compared to Japanese households holding 40% of JGBs. U.S. culture lacks the savings orientation and government bond preference seen in Japan. Most critically, if the Fed implemented yield curve control capping 10-year yields at 2% while inflation runs at 3%, it would create massive negative real yields, encouraging capital flight into inflation hedges like commodities, real estate, and foreign assets. The opposite of Japan's capital, trapped domestically by currency controls and cultural preference for yen assets. The second-order effect being missed is the impact on dollar reserve status through gradual diversification. Central banks globally held 71% of reserves in dollars in 2000. Current dollar share is 58%. The decline is gradual, approximately 100 basis points per year on average, but persistent. Alternative reserve holdings have increased in euros from 18% to 20%, yuan from 0 to 2.8%, and gold has increased from 10% to 15% of total reserves. This diversification reflects recognition that U.S. fiscal trajectory is unsustainable. Foreign central banks managing reserves have multi-decade time horizons. They recognize that U.S. debt at 123% of GDP with $2 trillion structural deficits will reach 150-160% by 2035 under current law. Interest at 21% of revenue rising toward 29% indicates debt service will dominate fiscal capacity. The rational response is to diversify before others, preserving optionality and reducing exposure to potential dollar debasement. The network effects of reserve currency status mean diversification is self-reinforcing. The dollar is the reserve currency partly because everyone uses it, creating liquidity and accepting it for trade settlement. As central banks diversify away from dollars, it reduces dollar liquidity marginally, making alternatives more attractive. Other central banks observe the diversification and follow. The process feeds on itself. Each increment of diversification reduces the network advantage that made the dollar dominant. What's being completely ignored is the political economy incentive structure. Elected officials have strong incentives to avoid fiscal adjustment. Spending cuts anger constituencies, dependent on programs. Tax increases anger taxpayers. Both reduce re-election chances. The rational individual political strategy is to defer adjustment, allowing deficits to continue, and hope the problem becomes the next administration's concern. But aggregated across hundreds of elected officials over decades, this individual rationality creates collective disaster. This is Dalio's core insight that mainstream analysis misses. Systems fail not because leaders are stupid or malicious, but because individual incentives reward behavior that collectively destroys the system. British leaders in the 1920s were not stupid for trying to return to gold standard. It served domestic political needs and appeared to restore credibility. But it worsened the debt spiral. Weimar leaders were not malicious for monetizing debt. Refusing would have caused immediate crisis, but it led to hyperinflation. U.S. leaders are not incompetent for running deficits. Each dollar of spending benefits specific constituencies more than the distributed costs of debt service. But accumulated over time, it creates unsustainability. The missing element is recognition that systems reach points where all available choices produce bad outcomes. Inflating away debt destroys creditor wealth and currency confidence. Defaulting destroys creditworthiness and triggers immediate crisis. Implementing austerity triggers recession and political backlash. The U.S. is approaching this trilemma where no politically feasible solution preserves both fiscal sustainability and currency stability. The signal warns that the United States has entered the phase of the long-term debt cycle that Dalio identifies as printing money and buying debt, where fiscal deficits become so large that they can only be financed through monetary expansion, beginning the process that erodes reserve currency status through inflation and loss of purchasing power. The first implication is that the Federal Reserve's independence is compromised. Officially, the Fed sets monetary policy based on inflation and employment data, independent of fiscal considerations. But with federal interest expense at $1.2 trillion annually and rising, the Fed's policy choices directly affect fiscal sustainability. Raising rates to combat inflation increases interest expense, worsening deficits. Keeping rates low accepts inflation, but facilitates government borrowing. The Fed has become fiscally dominated, unable to set policy purely on economic grounds because fiscal implications override other considerations. This creates the conditions for what Dalio terms monetary financing, where the central bank's primary function becomes financing government deficits rather than managing the economy. The Bank of England operated this way from 1939-1951, capping yields on gilts at 3% to enable war financing. The Bank of Japan operates this way currently through yield curve control. The Federal Reserve operated this way during World War II. The difference is that previous episodes occurred during existential wars or after financial system collapse. Current conditions involve neither, suggesting the shift to monetary financing is occurring during peacetime due to structural fiscal dysfunction. The second implication is that inflation becomes the adjustment mechanism by default. If fiscal consolidation is politically impossible and default is unthinkable, the only remaining option is inflating away the real value of debt. If inflation runs at 4% for a decade, while nominal debt grows at 5% and nominal GDP grows at 6%, the debt-to-GDP ratio declines from 123% to approximately 90% purely through the denominator growing faster than the numerator. This approach was used post-World War II, when debt-to-GDP declined from 119% in 1946 to 55% by 1955, through inflation averaging 5.7%, while nominal GDP growth averaged 9.3%. But the difference is that post-World War II inflation was accepted because it followed wartime price controls and was seen as temporary return to normalcy. Current inflation would be recognized as deliberate policy to erode debt value, destroying creditor confidence and potentially becoming unanchored if expectations shift to anticipate ongoing high inflation. The third implication is that wealth transfers accelerate from creditors to debtors through inflation. Bondholders holding $28.3 trillion in treasuries lose purchasing power if inflation exceeds yields. Current 10-year yields at 4.5% with inflation at 2.5% provide 2% real return. But if inflation rises to 4%, while yields remain 4.5% due to Fed intervention, real return becomes 0.5%, effectively transferring wealth from bondholders to the government through inflation tax. The fourth implication is that reserve currency alternatives gain viability. For decades, no alternative to the dollar existed with sufficient scale, liquidity, and credibility. The euro had scale but faced existential crises and peripheral members. The yuan had scale but lacked convertibility and rule of law. Gold had credibility but lacked scale for modern transaction needs. But if dollar credibility erodes through inflation and fiscal dysfunction, alternatives that were 80% as good become relatively attractive, triggering diversification that further erodes dollar dominance through network effects. What breaks first historically is the bond market. Long-term yields rise above where the central bank can control them without unlimited intervention. Term premiums surge, pricing inflation and credit risk, and foreign buyers withdraw, forcing domestic absorption at higher yields. The U.S. has not reached this breakpoint, but the November 2025 data showing interest at 21% of revenue indicates proximity to thresholds that trigger reflexive dynamics. Ray Dalio warned that when government debt exceeds 100% of GDP with rising trajectory, when interest expense exceeds 15% of revenue and rising, and when internal political polarization prevents necessary fiscal adjustments, the system enters the terminal phase of the long-term debt cycle, requiring either inflating away the debt, defaulting explicitly, or losing reserve currency status gradually through foreign diversification. The data released in November 2025 confirms the United States has reached all three conditions simultaneously. Federal debt stands at 123% of GDP. Interest expense reached $1,204 trillion, 21% of revenue, for the first time exceeding defense spending in peacetime. Structural deficits exceed $2 trillion annually, with no political coalition supporting the $2 trillion in spending cuts or tax increases required to achieve balance. The historical precedents Dalio studied: British pound 1914-1945, Weimar Germany 1921-1923, Dutch guilder 1700s, Spanish real 1600s, show that reserve currency transitions follow predictable patterns once debt and interest metrics cross critical thresholds. Gradual loss through foreign diversification is the optimistic scenario, requiring decades. Rapid loss through inflation or crisis is the pessimistic scenario, occurring within years. The U.S. trajectory depends on choices not yet made. Fiscal consolidation through bipartisan compromise on entitlement reform and tax increases would stabilize debt ratios, but appears politically impossible. Monetary financing through Federal Reserve, yield curve control, or renewed QE would suppress interest costs, but risk unanchored inflation expectations. Explicit default is unthinkable, but implicitly defaulting through inflation remains option of last resort. What Dalio's framework reveals is that these are not three separate possible futures. They are phases of the same process. Initially, monetary financing suppresses interest costs. Eventually, inflation accelerates beyond control. Finally, either explicit policy shifts impose austerity and recession to restore stability, or the currency loses reserve status as creditors recognize the debt will not be honored in purchasing power terms. The November 2025 data moves this framework from theoretical warning to empirical confirmation. The long-term debt cycle is not a distant risk. It is the current condition.